Okay, let's unpack this. We're diving deep today into something really fascinating, how we truly understand financial markets. For so long, the conventional wisdom, it's focused almost solely on price watching charts, looking for patterns.
Hmm.
But what if that's just scratching the surface? What if there's a whole vibrant human dynamic underneath that we've maybe been overlooking? Get ready for a perspective shift because this could really change how you look at the entire financial world.
Yeah, what's fascinating here, I think, is this compelling argument that modern financial markets have, well, increasingly drifted away from their fundamental mechanics, that dynamic engagement between actual buyers and sellers.
Right, the real nuts and bolts.
Exactly. We've layered on so many abstractions, technical indicators, these really sophisticated algorithmic trading models, sentiment scores. And in doing that, price itself has become almost this object of worship.
Like the only thing that matters.
Precisely. Instead of seeing it as a result of observable human behavior, we just, well, we stare at the numbers. So, our mission today really is to explore understanding markets not just through price, but through this foundational idea of engagement.
Okay, and this next point, I think it fundamentally shifts how we understand what we're even looking at. The core problem identified is, like, why do we treat price as both the input and the output?
Hmm.
It creates this kind of self-referential loop, doesn't it?
It really does.
I mean, think about technical analysis.
Hmm.
It uses historical price patterns,
Hmm.
right, to predict future prices.
Yep. Price predicts price.
And quantitative models,
Huh?
often built using, guess what, historical price data.
Same thing again.
Even sentiment indicators, which try to, quantify emotion, they typically derive from proxies that are ultimately rooted back in price somehow.
It's exactly that kind of circular logic. It's sort of like trying to solve for X using only X. You just can't get outside the system.
Yep.
There's a powerful analogy here thinking about the mystery of the pyramids. We look at them, they're impressive, they're grand, but we don't fully grasp how they were built. What were the exact processes, the techniques that led to their formation? We lack that preserved knowledge.
Right, the how is missing.
The how is missing. Now, contrast that with something like, say, the Great Wall of China. We understand its construction much better because the process was documented. So what this implies for markets is actually pretty profound.
Which is?
If we truly understood the mechanics of buyer-seller interaction, the actual construction process of price formation, then price wouldn't be this mysterious, sort of unknowable thing.
Okay.
It would be logical, it would be explainable, and frankly, far less prone to misinterpretation.
So if price isn't the whole story, if it's this kind of enigmatic output, how do we actually begin to look beyond it? What's the fundamental principle here that redefines how we approach market understanding?
Well, it means shifting our entire perspective to what we're calling engagement. Price doesn't just magically appear on a chart. It emerges from this engagement.
Okay, engagement. What does that actually entail?
So when we talk about engagement, we're talking about a multifaceted process. It includes negotiation, naturally, disagreement, and agreement. That's the core. But it also involves things like settlement, the formation of expectations, what people think will happen,
Right.
the provision of liquidity, who's willing to buy or sell right now, and the assessment of opportunity cost.
Opportunity cost.
Yeah.
What they're giving up.
Exactly. What other trades or investments they're foregoing by making this one. And what's crucial to grasp here is that these aren't just abstract economic terms. These are tangible human behaviors,
Yeah.
embedded in every single trade that occurs.
That makes sense. And there's a metaphor to help illustrate this, right? The chessboard.
Yes, the chessboard metaphor. It's quite powerful.
The market is a chessboard. It has no meaning unless players engage.
Mm-hmm.
Think about it. The pieces on the board, they represent the different roles.
Yeah.
You've got buyers, sellers, huge institutions, individual retail traders like you or me, maybe.
Right, all the players.
And the entire game of the market. It's all about strategy, isn't it? About reading intent, anticipating moves, managing risk. It's this active, dynamic process between these players. It's not just pieces sitting there.
Absolutely. And importantly, that metaphor comes with a critical cautionary note.
Which is?
When greed dominates over understanding, mediocrity follows.
Yeah.
It really underscores that a deep comprehension of these underlying mechanics, this engagement, is vital. Just chasing a quick win without actually understanding the game you're playing, that often leads to, well, suboptimal outcomes, mediocrity.
Okay, so this brings us to a proposed framework then, a way to actually apply this thinking,
Yeah.
a four-tier model,
That's right.
aiming to rebuild our perspective from the inside out, rather than the usual, outside-in price-first approach. What does that look like?
So this model starts at the most fundamental level. Tier 1 is human behavior.
Okay. The psychology bit.
Exactly. The motivations, the biases, the decision-making processes of all the individual actors in the market. Moving up from there, Tier 2 is buyer-seller interaction.
Where the action happens.
This is where we analyze how offers meet bids, how liquidity flows, the precise mechanics of how trades actually physically occur. Then, Tier 3, market structure and microstructure. This gets a bit more technical.
Like the plumbing.
Kind of, yeah. It delves into things like order books, those
Mhm.
electronic lists of buy and sell orders waiting to be matched to the exchanges themselves, and the entire sort of circuitry of the trading system. And then finally, only at Tier 4 do we get to price formation.
The end result.
The final outcome, yes, presented as the ultimate result of all those previous layers interacting. Now, the crucial point here, and this really highlights the common failure in analysis,
Yeah.
is that most analyses, they start at Tier 4. They start at the price and they completely skip, or maybe just gloss over, those first 3 foundational tiers.
Right. They jump straight to the score without watching the game.
Precisely. And that's why they often fail to truly understand the market's real movements and dynamics.
That makes so much sense when you lay it out like that. Okay, so practical stuff. What does this shift in perspective actually mean for different people involved in the markets? How does this new understanding apply in the real world for, say, a trader or an analyst or even someone teaching this stuff?
Okay, let's break it down. For traders, the implication is pretty clear. Stop treating charts as, holy scripture.
Easier said than done for some.
Perhaps. But instead, the focus needs to shift. Understand who's buying and selling, and maybe more importantly, try to figure out why. Learn to read things like order flow.
That actual stream of buy and sell orders.
Exactly. The raw data of participation, not just the visual patterns on candlesticks.
Okay, and for analysts?
For analysts, this means building models that actually try to incorporate these participation dynamics. Move beyond just looking at volatility and volume numbers in isolation. They should be leveraging fields like behavioral economics to interpret market sentiment, really understanding the human element that's driving it.
Got it. And educators, how should they teach markets?
Well, for educators, it suggests a really fundamental shift. Teach markets as social systems, not just mathematical or purely economic ones. Emphasize things like market microstructure, game theory, psychology. Bring those elements right into the core curriculum.
And looking ahead, this isn't a static idea, right? This concept, it opens up some pretty fascinating future research directions, I'd imagine.
Oh, absolutely. There's a lot of potential here. Think about how we could use agent-based modeling.
Simulating lots of individual traders.
Exactly, simulating thousands of individual virtual traders interacting to really see how prices emerge from their collective actions and biases. It's like a digital laboratory for engagement.
Cool. What else?
Or natural language processing, using AI to analyze trader communications chats, news commentary, social media to try and extract actual intent or shifts in sentiment, looking for subtle changes in language that might betray shifts in engagement before they fully show up in price. We could conduct more behavioral finance experiments, simulating these market dynamics in controlled lab environments, observing how different documented human biases play out in real-time trading scenarios. There's also digging into historical case studies, market crashes, bubbles, anomalies, but looking at them specifically through this lens of engagement dynamics.
Reinterpreting history.
In a way, yes. And even looking at decentralized finance, or DeFi. That's a whole new arena where these engagement rules could potentially be redefined entirely, maybe free from some of the old institutional structures. These are all avenues for a much, much deeper understanding.
So pulling it all together from this deep dive, it really feels like the big takeaway is, well, that markets shouldn't be treated as these mystical forces or black boxes that we need supercomputers to decode.
Right.
They are really at their core games of strategy, psychology, and economics, played by real people with real motivations and, importantly, real stakes.
And if we connect this to the bigger picture, the really profound conclusion is this. When we lose sight of that truth, that human interactive truth, and we reduce everything down to just price, we turn the market into that pyramid again. Grand, impressive from the outside, but ultimately fundamentally unknowable because we ignored how it was built.
That leads perfectly into this final powerful statement that really encapsulates the whole argument.
Mm-hmm.
Price is not the game.
Mm-hmm.
It is the score.
That's it. That's the huge takeaway. It reframes everything.
It really does. And this raises, I think, an important question for you, the listener, to ponder. What other scores in your life, maybe metrics you track at work or numbers you watch in your personal life, might actually just be the result of a deeper, more human, more complex gain that's truly worth understanding? Something to mull over until our next deep dive.